Good evening, everyone. Welcome to Admiral Markets. Thanks for joining us. We're going to take a look at spotting and trading with support and resistance on this webinar at 6 p.m. 27th of August at Admiral Markets. My name is Chris. Nenad FX is also with us, and together we're going to take a look at this topic. First of all, though, be aware that this webinar is intended for a global audience, is broadcasted to a global audience, but may not be suitable for the entire audience. Please, to find out more information about that, conditions, and other details, visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, trading for exchange and global financial markets in general are considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer. Plus, you're aware of the risks involved when trading. Take a look at the MT4 Supreme Edition from Admiral Markets. 50 plus extra features, a lot of great things, including a correlation matrix and a sentiment matrix and alert manager, among other things. So admiralmarkets.com, you can find out a lot of information besides the analysis and webinars that are presented to you daily. So make that your home on the web, admiralmarkets.com. You can see, just click on the Find Out More button and you'll get more info on the Supreme Edition. So today we're going to talk about what is support and resistance and which levels are the most important and how can we use support and resistance in trading decisions. I'm going to share my views first of all, then Nenad is going to take it over and reveal what he thinks about support and resistance. So what are the key ingredients of technical analysis? At its very core, can we group things together? Right? There are a lot of things that we can do with price, a lot of things we can do on the charts. We can do a lot of analysis, but push comes to shove, if we really are forced to, let's say, make groups of and bundle certain tools and indicators together, is that possible to do so? Well, in my opinion, yes, we're looking at a totally bear chart here, right? But in my opinion, there are three major categories. And support and resistance is certainly one of them. So definitely a very important topic and one of the key ingredients to understanding market structure and being able to analyze any chart, any price and time frame is understanding support and resistance. The other two major ones, in my opinion, are trend and momentum and patterns. Those three altogether, when we master these three things of analysis, I think then we're at a very good level of analysis. Now, when you look at support and resistance, it's basically what can stop price? What could actually turn price back into the other direction? Whereas trend and momentum, we're talking actually about flow, about energy, about the push, about one directional movement. And patterns, in my opinion, is more like deposits, the soft spots perhaps, when price is either flowing with the momentum and the trend, or it's banging against the wall when it hits support and resistance. Those patterns could be chart patterns, candle patterns, candlestick patterns, perhaps even time patterns, which I refer to sometimes in the live trading room webinars. All right, so this is how we can recognize the market. So I will dive into 2 and 3, but today we're going to focus on number 1. Support and resistance. This is a fundament. And in a way, support and resistance is like that rock that we see perhaps in a river. The bigger the rock, the bigger the support and resistance, the more water it's going to stop, and water would represent then the trend or momentum. So which one's going to be stronger? The trend or momentum or the support or resistance? What's going to be stronger, the water or the rock? And it depends, of course, on how much water is flowing, how much power that is moving, and how big is the rock. And that's something that we're estimating in the Forex market as well. So how do we estimate support or resistance? We can use a lot of things. Amongst others, I'm going to have a long list here of just summarizing all the support and resistance that we can really use for estimating that. Historical levels, round numbers like parity 1000, 110, 120, 130. Historical levels, I mean levels that just tend to be respected very often in recent history or even going back perhaps longer. Quarter numbers, those are, for instance, 120, 112, 50, 117.50. Even on a lower time frame, even for instance, let's see, 110.75. Okay. Retested levels, Fibonacci levels, fractals, pivot points and Camarilla, trend channels and trend lines, moving averages, Ichimoku. There are basically a ton of them. And do we want to use all of them? No. It would be too much, and it would be too clustered, and we would not be basically be able to see, probably would not be able to see price action because to a certain degree, because it would be too cluttered and too busy. So we do want to be selective. Now, how we do that is something we'll discuss now. But this is basically just a list, and there are probably more I didn't even think about, but just a list of all the things we can think about. So let's talk more importantly about what is a strong support or resistance. I think a lot of these support or resistance are probably known to you. So what is the next step? How to kind of identify what is important, what is maybe less important, which ones to use, how to combine it. That's kind of the important formula here, or important step. I tend to distinguish two groups. And one of them is, let's say, the levels that are known to the market. Known to the market is really where all of us will agree, or maybe let's say 99% of us will agree, that these levels are indeed at that level. That might sound logical, but it's really not the case. If we use Fibonacci, for instance, I could use this swing high, swing low, you could use a different one, and we'll both have different Fibonacci levels. They're not the same. I have a fib on the chart. Half the world or more probably could have a very different level. So this is not necessarily known to the market. There could be some Fibonacci levels that are very logical, and probably there's a high chance that many traders will have the same level. But historical levels, round levels, even more obvious, 140 is 140, and everyone knows it's 140. No, there's no one's going to doubt about that. Quarter levels, just the same. Pivot points, almost like that. Pivot points do vary, and sometimes are a bit different, but the differences, on average, are not that much different. I would still classify it as a level, roughly speaking, that is known to the market. Fractals, not as clear as round levels either, but also here, in many cases, they are the same. So it's good to look at these levels because these are kind of like levels that typically will be respected. Now, we don't have to use all of the fractals on all time frames. That's something I'll dive into later. But if you look at one time frame or two, you could use all of these things really on that time frame. I wouldn't use all of these support and resistances on all time frames because then it's getting too much. But we'll talk about time frames in a second as well. But these are good things to keep an eye on. Pivot points is definitely optional. It's not something that everyone has to do. I would say round levels, fractals. Fractals is also not something that everyone do. Probably the only thing that everyone looks at are round levels, I would say, and perhaps nowadays also quarter levels. And historical pivot points or fractals is something that it's up to you. Personally, I use at occasionally almost all of them. It depends from case to case. Pivot points are definitely good for intraday trading as well. Then there's a second group. Let's say I call it just basically tested by your own observations. Those are trend lines, moving averages, test and retest Fibonacci, because that's basically something that we ourselves are seeing. There's no guarantee at all that someone else is seeing the same thing on another chart. Moving average we use, who knows how many people use that. The trend line we see, we could be the only one. So doesn't mean it's anything bad with it. It's just that when we're using something that is in our chart, we need to have tested that. We need to know from experience, from back testing, from forward testing, that what we analyze also makes sense. We have to verify if the market is indeed acting to, reacting to those levels that we put on, those tools that we use in the way we think. If we do analysis and we're seeing price react differently to our tools than we expect, then we just need to work a bit more on analysis. And it wouldn't be good to use the second group until we get more of a confirmation that what we're analyzing makes sense. You want to make sure that the analysis is done properly and that you get good feedback from your trading and from the market on how you do it. You need that verification. Otherwise, we might be analyzing something that is, and it doesn't work. So good tools and indicators, but we just need to practice. We need to gain experience with these things. That's very important. All right, so what is the strongest of all of these things, really? And it's, in fact, boils down to confluence. I would say a round level always has a very kind of heavy gravity around it. It will tend to be, used very high percentage, high chance that it will be used. But even better so is if there's a confluence, all right? Because when there's confluence, of course, there are multiple things at the same spot, and then the chance of price reacting to some degree at that level increases even more so. So it's a matter of experience as well to get a feeling for which levels could have a major impact, which perhaps less. And the more we use this concept, the more likely we'll be probably correct in assessing this is going to be a major level, this is not going to be a major level. Also, of course, it depends on how strong a trend is, how strong momentum is, because that's the other side of the equation. We could have a very strong support level, but if there's a strong trend, those things are then a bit more unequal. If it's a weak trend and a strong support, well, you get it, right? Those things are to be considered. Now, often enough, the first time price goes to a level, to a confluence level, to a support or resistance level, there's a higher chance that it will be respected than if it goes there a second time. The second time, there's a higher chance it will be respected than the third time. The more hits, there is eventually a chance the price will push through it, right? It's not to say that a retest, a second time the price tests a support or resistance levels that it's going to break. But the first time, there's just a higher chance it will bounce. Second time is still a decent chance it will bounce. But the third time, we're getting into a territory where we could see a push, a break. Fourth time, even more so. But the confluence of levels. So for instance here, we see, let me explain this graph. We see a magenta Fibonacci level. We see price here going down to the 50 fib, where I have the, let me make it orange, right here, right? That's, a bit higher. There's a 50 fib right there, right? There's also a minus 272 target. You see that? Right at the 50 fib. That's from the swing high swing level. And we see a 110. So what do we have here? We have a combination of a fib, that's our own observation, but we have two fibs, which makes it confluence. And I've used fibs so much that although it's my own observation, I have a lot of confidence in those fibs. As an extra, I see around 110 level. And as an extra, I also see actually momentum to the upside and more of a corrective move to the downside. It has nothing to do with support or resistance. That's that momentum side of the equation. But if we add up all those factors, we see momentum up, correction down. We see support at 110 due to three things, two fibs at least, and a round level. So we're looking at, confluence of four factors or so, strong reasons why price could bounce there. In case you think that's easy to say in retrospect, then you can I actually said this live in the webinar when price was here, right? Right there. I went at that spot. So it still had to retrace a bit lower. 110 is seen as a round level because basically anything that has a 0, 0, the very two last digits are 0, 0, that's a very round number. 110, 0, 0. Because otherwise we would say 110, 10, 110, 22. Those are just normal numbers. Anything that ends up with two zeros is definitely a round number. 120, 0, 0. 130, 0, 0. And why is it seen as a round number? Yeah, because it doesn't have all those digits really that, a lot of options you could have, let's say 1, 10, 11, It's round, it ends on those zeros, that's why. 50s are also important. Those are like quarter levels. 25 at the end, 75 at the end, 50 at the end. Those are quarter levels, also important. Indeed. So, time frames. If we use all this, of course, we're going to see tons of support and resistance, and we're just going to get a bit puzzled by everything. So, what are support and resistance to really reckon with? Well, if we're looking at the same time frame, it's not bad to keep an eye on support and resistance, or a higher time frames. Lower time frames is really not that important because if you're trading on a 4-hour chart and there's a support or resistance on a 50-minute chart, well, there's a good chance that 50-minute support or resistance will just break and vanish within that 1 4-hour candle. So it's not that relevant. Therefore, the lower time frames we go, theoretically, the more support and resistance levels there could be. If we're trading on a 5-minute chart, there are a lot of support and resistance levels on all those higher time frames potentially. Now, obviously, if you're trading a 5-minute chart, the chance that you'll actually bump into a weekly resistance or support is not that big, but occasionally it will happen. Occasionally it will happen. Not that often, but once in a while we're really going to bump into that big level. So if you're trading off that 5-minute chart and you don't know that weekly level, you're going to be in trouble with that trade, most likely. So lower time frames just has a lot more levels in theory to reckon with. So if you're trading on a daily chart, well, you only have to take care of or review the daily, weekly, monthly. So that's a lot less work. It's a lot bit less difficult because of that. I think personally, in my humble opinion, that one time frame higher than you're analyzing or let's say trading or where you typically look at the trend, that's probably the main time frame you want to look at. What does that mean? So if you're trading on an hourly chart, probably 4-hour chart is the most important for looking for support or resistance. And you probably won't bump into many weekly support or resistance levels on a 1-hour chart, but you will occasionally. 4-hour chart, probably daily is the most important. You won't bump into many monthly levels. Daily chart, probably weekly is the most important. I mean, this is not a very hard science. You could maybe even come up with a lot of arguments to say, I think 2 time frames is more important than I might agree with many of those points, but in general, I think one time frame is a good rule of thumb. So how can you use support or resistance for trading decisions? We can use it as a filter, which is basically looking at that one time frame higher, looking at the daily chart and saying, wow, here's big resistance trend line. Here is a 112.50 support on the euro dollar rate, quarter level, for instance. And saying, okay, I'm not going to short right into 112.50 if price is at 112.60, 10 pips to go, and a high chance that price is going to bounce at 112.50. These kind of calculations, ultimately, there's no formula for that. At least, could be cool, actually, maybe a good idea to try. But, this is something that you're going to have to, through experience, kind of balance out. Okay, I have a shorter potential here at 112.65, but there's a round level at 112.50. 15 pips, my risk is 30 pips. Is it worth 15 pips for 30 pips risk? And there's a high chance there's going to be a bounce. Probably no, so probably better to skip that trade. That's filtering out a trade. Right? Maybe another scenario could be short at 112.80. There's still 30 pips, but I only have 25 pips risk. That could be maybe worth it. Okay, I know there's a high chance of a bounce, but still maybe worth it. Or maybe a different scenario, a short at 113.40. Okay, 113 is a round level, but it's not maybe as big as 112.50 because that's a quarter level. 110 is the biggest, 100, 110, 120. Right? Then the quarters, and then let's say the singles like 113, 114. Could be a bouncing spot, but there's no confluence there, and there's a good trend. Well, in that case, with 40 pips to go, it's probably worth it. So this is kind of a balance, trying to measure support and resistance, trying to measure the momentum. We can use it as a trigger. That means trying to trade off of it. Therefore, trade breaks or bounce basically is an enter. Exits, stop losses, take profits, and use it for trade management. So I talked a bit about filters and it basically boils down to estimating how much space is there from the setup, from the entry, up to or down to that next support or resistance level. And if price is too close, then it could be good to skip it and filter it out. Now, once again, if you're looking at a setup on a 4-hour chart and there's a 15-minute support or resistance, 30 pips from there, that's not important, right? We're talking about on a 4-hour chart, then looking at the daily chart and avoiding going along at let's say 109 on the euro dollar, 109, I don't know, 109.75, because 110 is around the corner. That's filtering out a trade. Then we can use it as a decision spot to really trade, because each support or resistance level is going to be like kind of a decision spot. Will price bounce or break? And it gives us information about that. If it's not a decision spot, I call it in the middle of nowhere. And price can kind of do both things. It can always do that, but I mean, let me rephrase that. It's at a spot that doesn't give us desirable information of a real reaction. There's no high probability that I would attach to any movement there. It's maybe a better formulation. So when price gets to a decision spot, I'm interested because there's a higher chance that when price reacts to that level, it has some major consequences. There's a substantial reaction, either a bounce or a break. So for instance here, when price hooks back to the long-term moving averages, bounce or break, bounce or break. In these cases, we had bounces, right? Bounce back to the upside, bounce back to the upside. And well, that is a decision spot. It's a trigger. It could kind of, how do you say it, make us interested in potentially trading it. Sometimes I'm only interested in one side. Sometimes I could even be interested in both sides. If there's a trend line, I could be interested in a break to the up or downside. Sometimes there's a strong trend going on or strong momentum, and I'm only interested in the break to one of the two sides. Like for instance here, let's see, 1 second. There it is. Okay, here for instance, the break of this resistance, it's not this resistance here, right, is great. We trade that, that's with the trend. But perhaps now the trend is so established that the downside break here, I might not take it. I might wait for price to really push through and then take a continuation instead. You get my point? If not, let me know. All right. So decision levels basically are lines in the sand. They are where price has to make a choice. And as a trader, we're waiting for the market to decide. Sometimes, if we have enough experience, we could take the decision before the market decides and take that risk. The advantage is that we get a better price. But if you don't have that experience yet, many traders are just jumping in trades. You'll be over trading them if you don't have that experience, because you don't have the kind of the experience yet to say, okay, this is a major level and this is going to do that or that, and I'm going to take that risk, and the reward to risk is compensating that. If you don't have that experience, you're going to see those levels everywhere, and before you know it, you'll be over trading. Experienced traders can weigh that and can say, this is really so much confidence, such a major level, there's a high chance it's going to bounce here. I'm going to take the trade before even the price even reacts to that level. And then you got a better price. If you don't have that experience yet, personally, I recommend to wait for price. And even experienced traders sometimes are better off waiting for a confirmation, like a candlestick pattern, so that there's a signal there, there's indeed information that the market is seeing and respecting that support or resistance level. And by waiting for the market to decide, as a trader, we're following price and not predicting price. And we're following our trading plan and not trying to be a fortune teller. We are waiting for the market to decide, and then we're following wherever that market wants to go. We're jumping on the bandwagon. So instead of leading the market, we're smartly following it. That's the advantage. Now, many very good traders will say, you're too late, etc. The key to that part, a bit true. The key to that, of course, you're going to get a worse price. The key is that if you wait for a reaction, there has to be sufficient reason for you to think that the bounce is going to be not a small bounce, but a bigger bounce. And what could help with that? A trend, a momentum. Because when price then bounces into the upside, and there is an upside trend, then there's a higher chance you're going to see follow through. So you need that follow through. All right. So a bit about entries. I'm running out of time, so let's take a look. This is the euro dollar 15-minute chart. You can see two trend lines. I was talking about it on Wednesday, and I said, both breaks are interesting. Really, because we had a massive upside momentum on the euro dollar, but we had some good downside momentum in the meantime too. So I was open to both sides. Break of the resistance, potential for longs, break of support, potential for downside. Those were the lines of the sand. Those were decision moments when price goes through it. That's when I'm interested in trading it. If it stays between those trend lines, I could trade bounces, or I could just wait for the break. Just hang on and be patient for that moment. That's basically waiting for the bounce or break. In this case, I was waiting for the break, not the bounce, because if the triangle is small, the bounce trade doesn't have much space. Basically, when you get the break, by the way, here, you see a small little pulse, right? That's a classical break, pullback, continuation. When you break This fractal, it's a continuation, and you can see the acceleration. That is right here. Break of the trend line and the follow through. All right, follows through. Where does it hook back? To the 50, bounces at the 50, breaks this trend line, bounces again at the minus 272 target. So we got a bearish break, a second bearish break, a continuation. We have again a bearish bounce at the 50, a bearish break at the trend line, and then a bullish bounce at the target. And then we had this morning, in fact, a bearish break here. We had bearish break here, bearish bounce, bearish bounce, bearish break, bullish bounce, bearish bounce, bullish bounce. Just to give you an idea. Not all of these are tradable, not all of these, you want to catch, but just to see the principle. And where could we exit? Using this principle, basically at the next major support or resistance, or at the next, reasonable bouncing spot, if you're taking a break. Or if you take a bounce, the next bouncing spot in the other direction. All right. So live charts is a bit too little time for that. That was my part. If you have any questions, let me know. And otherwise, I'm going to hand it over to Nenad. Oh, there's one question here. How do you know when to let the profit run and when to take profit? Well, it basically, part of it is about analyzing the support or resistance, really. And you could try to see which levels have a lot of confluence. If there is a support or resistance level, but it doesn't have much confluence, you could take maybe a bit of profit there and try to see if you can break through after a retrace and try to catch a next push. You could use the Fibonacci sequence level, for instance, in understanding where the biggest push could come. That I don't have enough time for that, unfortunately. Let me drop my email and I'll send you a webinar that I spoke about on that. Okay. In the meantime, I'll pass it over to Nenad.
Thank you, Chris. So we can continue with our webinar, support and resistance. Well, not always support and resistance will hold. As you can see sometimes, and I stated that many times before, during August, there can be some levels which are not defended so hardly. And that is because August does not have a big volume in trading. And I especially mean about, and especially think about equities and other markets which can have a really big influence on Forex movements. And in September, it should continue. So basically, starting from September, situation should be much better considering support and resistance levels. And when big banks are having some sort of vacations, they tend to apply algos or algorithms which basically step in to correct the price. And we have seen those algos stepping in exactly when euro went to 1.7. So basically now the thing is, what I want to say is, you should, that is why me and Chris are always trying to educate you. It's not important that you trade with 30 pip stop loss or 100 pip. It's the same. 30 pip stop loss or 100 pip stop loss is always the same, because your risk in trading those kind of movements is always fixed. So 3% or 2% or 1% of a risk is the same for 30 and 100 pip stop loss. So instead of making 0.5 for one full lot, you enter usually with lower lot size according to your stop loss. So that's why we are really in a big advantage over some, I need to say, traders who just do not know. They overtrade and over risk when they do with 20 pip stop loss, and they use the same entry for 100 pip stop loss or 50 pip stop loss. It's not like that. You always need to have your risk fixed, and you need to choose what would be your risk. If I lose a trade of 50, pips or 100 pips, because that support or resistance didn't hold, I'm not bothered because it's only 2% of my account, right? So it's the same, 30 pips stop loss, 100 pips stop loss. Risk is what should be fixed. Stop loss is dynamic, risk is fixed. And maybe today there will be a good opportunity to talk about failed support and resistance pattern, because so far what I see, dollar yen is not holding. Basically, after the analysis, it went for some 30 pips in profit, and yet it didn't hit stop loss at this part, but there can be an opportunity. But that will be a good showcase to show you how sometimes that support or resistance does not hold, okay? And why it's important to analyze, as Chris said, analyze, okay? Analyze support and resistance, okay? So we will today talk about exactly support resistance, 1 hour, 4 hour, and then of course I will be showing you live charts, okay? So trends do not move in straight lines. They zigzag in general direction, forming progressively higher or lower peaks and lows. When you see this, you know that there is a trend forming in. So usually this is a sort of uptrend, this is sideways movement, this is downtrend. And when you see this, you know that these lines should hold, because if these lines, which are support and resistance lines, if they do not hold, they are broken, and then either they can start a new trend, or if it's a false breakout, they can go back within the boundaries and then trade as according to a trend. Okay, so if trend line is respected, then there is a big opportunity that the trend will continue. If trend line, and I'm talking about trend line, important trend line, being broken, that means that new trend can be formed, okay? Now, support turns into resistance, or resistance turns into support. Always is the case when we have basically a retest of formerly broken resistance or support, okay? So if we have, for example, if we have a trend line which is broken, as in this case, we know that there is a big possibility that the trend will reverse, and it's the truth, because this was obviously trying to break the trend line. Trend line was holding, but then you can see the trend line has been broken and the price just went above and retested the trend line. Okay, same for every market. Okay, bull market, bear market, whatever. Trend lines or support or resistance, horizontal levels are what should hold the price. Okay, so basically horizontal support and resistance lines are called support and resistance. So those are trend lines, nothing more than trend lines, and those trend lines are based on either previous pivot points or in price action wicks and bodies of candles, usually wicks. So we need to use 1 hour and above charts for support resistance levels, okay? Especially if you trade, if you love to trade price which is traded on lower time frames, effectively scalping, you need to use 1 hour and above charts. So 5-minute support resistance lines are not important. 15 minutes also. So usually during those scalp swings, you need to use 1 hour charts for support and resistance levels. For 4-hour trading, you use daily. For daily, you use weekly. So basically, and monthly occasionally. So that's important to know. Always use higher time frames, okay? Because higher time frames usually have stronger support resistance levels than standard lower time frames, okay? 1 hour is commonly used for intraday trading, so 1 hour is only intraday and scalps. It's not always that you use 1 hour for intraday. Sometimes you use 4 hour, but if you use 4 hour, then you need usually to be patient with trades, because sometimes and very often those trades can switch from intraday to intra-week positions, and usually if you know how to do it, that can really give you much better risk to reward. But sometimes, as I have stated a lot of times, risk to reward is not that important. Even though if you have one-to-one risk to reward, but your system is 80% successful, if you use proper money management, you would be successful. Okay, so it's not always that risk to reward is always important. It was important back in time in old school trading, but the new approaches definitely show why I have the account which where I can really prove that, because on that account risk to reward is not that high, but because my method is 80% successful, I am 53 pips positive. No, 53% positive on that account. So basically that's the proof that you don't always need to have best risk to reward, and the account is 3 years old, so basically it's not 1 or 2 month account. So I'm a living proof for all what I say. Okay, if you use one-to-one risk to reward, and especially if your system is correct and successful, then overall you will be profitable. But the biggest problem is always, as we speak, it's always about the risk. If you over risk and if you over trade, if you use revenge trades often, then definitely it's not your system, it's your psychology which is making losses, right? So do not underestimate the power of higher time frames. If you do 5-minute trading, then 1 hour support resistance lines should be drawn. If you use 1 hour trading, then you use 4-hour time frames. If you use daily trading, then you use weekly. Okay, so it's always about higher time frames. Yes, Jen is asking for 1 hour chart, support resistance is based on 4 hour. Yes, if you trade 1 hour, you watch for 4-hour supports and daily also. But 4 hour has the advantage because interim support and resistance will be 4 hour. Also, you should watch for daily if you trade 1 hour, but 4 hour is always great, always. Weeks is important. Now the question, why weeks is so important? Okay, this is the candle, right? This is the wick. So this tells you that there is now moment buyer in the market. Okay, and wicks for me are more important than bodies because this is effectively the low of the candle, and this tells us that there was a buyer here, and exactly at this price the price jumped. Exactly at this level price jumped. Now if you look back to the left, you will 90% of the time you will notice that in the history this was the same level where price also jumped. Okay, so the question, does it mean that if you trade 1 hour we don't look left if we have support resistance lines? No, you're not right. You always need to look to your left, and I will show you later on live chart how you should do it. You can do it yourself, you can do it manually, so I will show you how to do that. So wicks are very important, do not forget it. That is the ultimate truth in Forex, because that tells you historical versus now moment buyers and sellers. Okay, that's always the truth, and there is no bigger truth than that. There is no one can tell you anything because you can see historical price action and compare it with current price action. So if you see this, you know that there is a strong buying here, and probably in the past there was also buying. Wicks is the shadow of the candlestick. So if this is a candlestick, these are the wicks here. Okay, so that is the wick, shadow of the candlestick. So now we were talking about static support resistance levels. We can also use combinations of EMA, and those are two most popular combinations, which are basically dynamic support resistance levels. 30, 50, 100 EMA, 20, 50, 200 EMA. Plot this on your charts and you will see how the price responds to 35, 50, 100, 20, 50, 200. So you will see. You just need to put it on your charts and you will see the power of these EMAs. Okay. Dynamic support resistance levels are also levels which move with the price. So we have Fibonacci levels, we have EMAs, we have all sorts of dynamic support resistance levels. And we are always ready to plot those if we trade dynamically, okay? Now, if we trade intraday, very often higher time frames we use static support resistance levels, and those levels are, for example, historical higher time frame levels, historical price action, Camarilla pivot points, Murray mat. So those are static support resistance levels. Okay. Jen is asking, is wick for both the top and bottom? Yes, this is. It doesn't matter if you see candlestick like this. This is the upper wick. This is the lower wick. So it's always the same. So if you see this candlestick, you know that there was historical now moment selling and now moment buying at this level. This was the selling level, and basically that's why we call this indecisive candle. We don't know where the price will go, and usually after indecisive candle we wait for the breakout of either support or resistance. I was talking about it on my webinar. It was a master candle webinar. So guys, please, if you still do not understand what the wick is and what the candlestick is, refer to my master candlestick webinar, and I explain candlesticks and wicks. So so far you should have learned that wick is the shadow of the candle, the tail. And if you're still not sure, of course, from 2nd September, I am starting a price action trading school. So you will learn a lot about price action, what you should use in price action trading, how to trade the price. So be sure to sign up for the webinar. It's already scheduled. It's scheduled for 2nd September. So be sure to sign up. Okay. Trend lines and channels, static support resistance levels, all those things you will learn. Okay. Now we are mentioning static support resistance levels because those are important for price action trading. Dynamic support resistance levels such as moving averages are also important in price action, but they also have its use in indicator-based systems, especially systems which are based on EMAs. Okay, this is weekly price action on Australian dollar, and you can see how the price reacts. Okay, and you see how the price is reacting historically and now moment to these wicks. So it's always strong confirmation of the trend. Always, guys, strong confirmation of a trend. Okay. The question: if there is downtrend and we get a doji, there is big chance that the trend will change and go up. Not always, Kathleen. Sometimes the thing is that there can be a profit taking or stop grabbers, so the trend can change. So you should not be worried about what market should do. It's only about you and how you analyze and trade. That's why I'm always saying risk management is the biggest part in trading. Okay, if you are angry at the market, it's you should never be angry at the market, because ultimately you can be right or wrong. But even if you're wrong, if you know how to manage your risk, your wins will offset losses. So ultimately you should be fine. Okay. Now, Carolyn is saying the market was good to me today. Well, Carolyn, congratulations. For me, at this point, it hasn't been good because euro dollar is very close to my stop loss. Dollar yen is not listening as it should, but I am okay because my risk is 4% on those trades, so it's not much. And if I win the trades, then it would be huge jump on that account. So I'm not, even if I lose, I'm okay. As long as you use proper risk, guys, you should not be afraid. Now, as I say, you can always gamble, so it's up to you. You can risk everything if you want to gamble. I personally know a trader who placed $500,000 and he lost half of it within first 2 months, and well, he doesn't listen. Basically, he loves to gamble. He's a professional gambler. What can I say? It's up to him. It's always up to you. Okay, so okay, so basically, when you see this, usually it's always best for the price to reach the second set of EMAs, because even then you can see it here. If it hits 200 EMA, it can reject, but it's usually very deep retracement. So unless you're ready to place a trade with of course bigger stop loss, then you should it's up to you whether you would take the entry here or there. But I personally, when I use 3 EMAs, I usually watch for bounces of these 2 EMAs. But of course, very often if I see that the EMA is broken, then I'm considering a jump at this point. Okay, and very often it will happen. But you should always, it's not just for trading, it's good for your analysis. Because for example, if you lost this trade because the price didn't listen to you, you know when this level is hit, you will not be shorting it. It can keep you out of the trade, and you still have another option and possibility to place a long. Okay, so those are 2 things that you're in advantage of. So the first thing, you will not be placing any shorts because 200 EMA is very close, and the second option, place a long trade. So basically, it's always like that. It will keep you from your bad trades, because you're looking at very strong EMAs, very strong. Okay, this is one of the examples. Watch the bounce wicks. Basically, of the examples in a bearish market, when you see that the price is going down, 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 it rejects from this point. Next time, when this level is hit, I expect another drop, and you can see it here, because this is called retest. Okay, this is called retest. Okay, Jen is saying you spoke of 30, 50, 100 Heiken Ashi. Yes, it's correct, not 200, because Heiken Ashi system uses 30, 50, 100, not 200. Okay, I gave you the example of non-Heiken Ashi. This is standard candlesticks, but also 200 is always a good support resistance level. Okay. It doesn't have anything to do with Heiken Ashi system, Jen. It's totally irrelevant now. This is the example of dynamic support and resistance level, because this is what the indicator is plotting. This is based on Fibonacci pivot points, and it's actually moving average dynamic support resistance levels. Basically, this is leading indicator, and it follows the price in real time and plots levels based on real-time price movements. Of course, it has a component of history in itself, because it draws the data from the history and it plots at the present time. So yes, this indicator is called Fibonacci pivot points. I think I have it, and I think I have it somewhere. So if you want to have this indicator, of course, as always, you can email me and I will get you the indicator. It's called Fibonacci pivot or something like that, but I can find it for you, and I have it, and it's actually good for spotting dynamic support resistance levels, because it will plot these lines real time based on Fibonacci moving averages, which are drawing the data, of course, from the past. Okay. So this is what the indicator looks like, and this is how the indicator basically can how it looks like on 1 hour time frame. Of course, it can be plotted on any time frame. Okay. This pivot points is not started in London Open, and you just need to plot it on your charts, and everything is fine. Those pivot points which I use for accurate pivot points, that is not free indicator. It costs a lot, and it's based on London Open on Admiral Markets platform, which is excellent because it uses ET time corresponding to the New York close time, and it's actually the best pivot point indicator so far. But It doesn't matter. Everything is useful. It's my job to provide you with best tools, so I'm very often you can see tweets from that accurate pivot point. This is basically pivot point. This is support 1, support 2, resistance 1, 2, and 3, and support 1, support 2, support 3. Okay. Okay, Carolyn, if you need some questions, you can ask me by email. I cannot tell you now at this point, so you are free to email me and I will tell you. Okay. So this is one of the components of some systems, and actually this is useful for traders who are trading counter trend trades. Okay, counter trend trades. So this is when you make an indicator, you ask a coder to get you an indicator, and coder usually has its price. So you need to pay for indicator to be made, because sometimes there is no free indicators over the internet, and you know the logic, and you tell the logic to your coder, and coder tells you the price, and after that he makes you indicator which is protected because you don't give a source code, you just give ex4 file. That is how it goes. So if you're interested in this particular indicator, yes, I can give you, it's free, and you just need to email me. Okay, this is one of the X points. X points is what I often use to pinpoint me a great resistance. And if you remember this trade which we had on our webinar, it was called it was a session recap webinar when I told you to actually sell the price at that point, and yeah, it was X point. It was X point resistance, and X point is the crisscross of two trend lines, usually accompanied by a confluence of a pivot point. And here you can see we have 61.8 straight through X point, and X point is made by these two trend lines, and this H4 is also part of the confluence. So you will learn about X lines on price action trading school. Now I'm mentioning it in the context of strong resistance, because when you see that two lines are crisscrossing, usually there is a strong resistance. Okay. Now this is also the example of 1 hour euro dollar chart. And this 1 hour euro dollar chart is actually having also X point resistance. And the first, if you remember, this was the analysis from a couple of days ago. The price hit 1350 and then spiked for some 1780 pips. So that is the power of these lines. Okay, 1350 is 50 level. 50 level is always used by big banks to place their orders at. So 0, 0, and 50 levels are natural support and resistance levels. Especially when you see 78.6 there, you know that there is a big opportunity for the price to spike. Also, there was a spike from this level, and today there was not a big spike from this level, implying that now, because this level has been, unfortunately for bulls, this level was broken. Now things can change, but we need to see tomorrow's close, because still there can be some big things going at the beginning of September, and I'll be analyzing that on Monday, guys. So be sure to sign up for session recap. There we will know where the price will head after the Friday close. Okay, but this is how X cross looks like. So this is X cross. You see the confluence of pivot point and X cross, and this is actually strong resistance here. And all of these levels are static support levels. Okay, 0, 0 level, 50 level, and of course another 50 level, spotted by confluence history of sellers and buyers versus now moment sellers and buyers. In this case, I was watching for historical buyers at these levels here. Of course, this is W pattern, but as I say, very often, especially during months when there are no lot of traders trading, there can be some illogical movements within the context of the market, illogical movements. And now if you see how price reacts, I'm telling you guys, look at euro dollar now, it jumped 40 pips from 0.0 level. So that is why I'm saying it's always how you analyze and manage the risk. Okay, only newbie traders would short into 12.00. Okay, it's the level for buy. This was also level for buy. Even though if you lose this trade, I'm still in this trade because price has not hit my stop loss. It went 2 pips from my stop loss, actually 4 pips because I also use a spread, and I always add a little bit of the spread to my stop loss. So actually, you see, even though if you lose the trade, it was justified because these are buying levels according to history. Your logic tells you that, and you should always trade how your chart is saying. You should not listen to, I don't know, people, to a lot of people, because it can kill your own judgment. You know, there is an English saying, an English expression, and I always use the expression. It says, always stick to your guns. And I really like the expression. It's very true, at least for me, because I'm always sticking to my guns. I just, I trade logically. If I see that this level is for buy, it's a buy zone or for buying, I really don't care. Of course, I'm not comfortable when stop loss is hit, but I'm accustomed to because my risk is very small. But I know that I have made the right choice, and you know that you have made the right choice, because many times in the future you will be right when you think like this. Because I know from my trading career, from my personal experience, when I shorted into supports, very often I lost the trade. When I was longing into supports, very often I have won those trades. Okay, and future will always tells you that the history is always repeating. Remember that. That is always the case in Forex market. Chart patterns using triple tops and bottoms, so X points, head and shoulders, inverted, confluence with manually drawn lines, buy low, sell high. Oh, I have noticed that now it's already 2 minutes past 7, so I need to hurry up, really. So this is how you watch the price. When you see 1, 2, 3, 4, 1, 2, 3, 4, you know that price is going sideways. Okay? When you see this price, this is usually bearish market, and you know that you should sell after breakout retest, or you can do with trigger happy, but it's up to you. Karen is saying, don't hurry. We like the webinar. Jen is asking why you're using 12.26.9 and not 8.16.5. Because 12.26.9 is suitable for Camarilla MACD, the analysis and trading method which I have been presenting you all this time. Okay. Screen is stuck. Okay, guys. Yeah, now it's okay. Using triple tops and bottoms, X points, head and shoulders inverted, confluence with manually drawn lines, buy low, sell high. Okay, and I was talking about this. If I lose this trade, and I actually have the trade on my account, 12.50 is buy, and I have my stop loss of 12.00. And actually, if I lose the trade, I know that I have made the right choice. It sounds like a paradox, but always behind the paradox is the big truth. Because if I apply the same logic at this spot here, look at the price. Potentially, I could have made 400 pips if I applied the same logic. Because after a breakout, how do we call this? Retest, right? Look at the triple bottom here. Using the same logic, I would have made 400 pips. I told you today that I have a long trade at this spot. I never hide any trades. I'm always sincere about wins and losses, because that is how professional analysts and traders should be, always sincere. Because if you're not honest, you know something is wrong then, right? And people will not take you seriously. And this is a serious business. And if my stop loss is hit, I would lose 50 pips, okay? But from the history, if I flip my charts to the left, I know that this was buying spot. Although this today we saw that the price break down, I can't sell here. I'm not able. My logic does not tell me that I should sell here. The history, which I am very fond of, really is telling me buy here, because last time when this level was broken and retested, we had 400 pip buying, and the only logic I could think of is place a pending order here at this spot. So guys, if you trade like this, most often than not, you will be right. You will be right. Even though sometimes, of course, there can happen some unexpected things, but more often than not, you will be right. Okay? Okay? Jen is asking, I have seen some of your charts, 8.16.5. Yes, 8.16.5 is for Forex range bars pro method. Okay, it's range bar setting. It's not price action trading. It's range bar. It's not Camarilla MACD, okay? Okay, that is, guys, other system. This is my Camarilla MACD. So, Jen, you are talking about FRB. No, I don't wait for any confirmation. This was my pending order, because very often I make pending orders based on my price analysis. As it's same as I usually show you on session recaps. Okay, so let's hurry this up. So triple tops and bottoms, X points, head and shoulders, confluence with manually drawn lines, buy low, sell high. So when you see M pattern, so this is point 1, point 2, point 3. After the point 2 has been broken, usually the price will proceed down. So this is bearish pattern. W is bullish pattern. 1, 2, 3 W. Usually the price will go up. Head and shoulders, neckline, retest of the shoulder, price goes down. You know my style of trading. Very often I short from the top of the right shoulder. I don't wait for any neckline. I short it exactly at this spot, and that is the time when I want to see double top. If I see double top here, I will short it straight from the right shoulder. If I see double bottom here, I would long straight from the right shoulder. Okay, this is my method of trading. I know that standard price action trading is saying wait for the neckline break, but I'm shorting from the top of the right shoulder, and I'm longing from the bottom of the right shoulder if I see double top or double bottom. That is how I do. Well, not always. I know that people are not always fond of this kind of trading, but that is how I do, and many times I have been right. How do I know when the right shoulder ends? I already told you. Confirmation is double top or a pin bar, shooting star. Okay, pin bar, shooting star. That is the confirmation when the right shoulder ends. Okay, you see the pattern and you see the candlestick or double top. That is confirmation. Okay, see here we have obviously we have had consolidation, breakout, but now in the history you see it here. This level was broken, retested, and it went down again. What should I expect next time this level is broken to the upside? This is the history, guys. Same thing, Australia, New Zealand pair. This level was buy spot. Here we saw big selling and it was rejected. Look at this history here. History repeats itself. Next time, what should I expect when this level is broken to the upside? Same as here. Buying, okay, from the bottom to the top. So history repeats. Okay, look at this. This was basically a touch of support. This was when this support was broken, retested, And now this, after a retest continuation, this support has become resistance. So you look at this, resistance, 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 false breakout, and another resistance here. So this is how those levels, you always should look for wicks. Wicks is what most important part of the candlestick is. Look at this, rejection. Look at this here. 1, 2, 3, 4, 5, 6, 7 rejections. 1, 2, 3, 4 rejections after the break of this level. That is the scholastic example. When resistance has become support. This was resistance here. Breakout, retest, continuation. This is support now, support now, support now. Breakout without any retest. This is definitely resistance. Okay? Always look for this. Always look for this. Breakout, retest, continuation. That is the conclusion for your level, that this has indeed turned. So if this was support, price has been broken in this level, retesting it. Now at this point here, this is not support anymore, this is resistance. That is scholastic example. After a breakout, pullback, continuation, or BPC pattern, support turns into resistance and vice versa. Okay? Head and shoulders, look at this. Top of the shoulder, double top here, very close. Break of the neckline, retest, continuation. The power of trend lines. Okay? And finally now we can see live chart action. Okay, I will show you live chart action. And this is our this is the example on dollar yen. I'm still holding this because my stop loss is 121.50. And this is good example. This pattern is called, I already done the analysis now. This is bearish pennant. And usually when you see this, you are measuring the distance from the pole to this, and you add to breakout point. Because GDP of US was a lot higher than estimate, this pattern could be invalidated. So this is the example how this upper trend line basically turned into support. So this was resistance trend line. This is the pole, flag pole. This is the pennant. Yes, the same applies for the flag. And what happened is, well, after the breakout here, okay, basically we are seeing some exactly that this was how it should have looked like. And my short was hit here. Now I am in a drawdown, but this is the exact how it looked like after it was broken and retested to the upside. So basically now this is bullish for dollar, but we don't know what will happen because tomorrow is profit taking and next week is new month, so there can be, I still think that this could go down, but we will see. It's my opinion, and as I said, I'm always sticking to my guns. I don't care what tons of other people think. This is my opinion, so I can be right, I can be wrong. There is no third part of it. So it's black or white. Either you're wrong or you're right. There is no middle. So, but this is what I have learned when I started to trade. Flagpole and one of the most basic patterns, flagpole with a pennant. And when it breaks to the downside, you usually add the flagpole distance to the point. But very often we can, if we want to get early in the trade, not waiting for 100 pip drop, we can basically short it from this level. Now obviously this is broken. Now we need to see stop loss is in place. I'm not worried because I have stop loss, right? I'm not trading without stop loss, and we will see. Okay, so guys, I will now show you, because we don't have much time really. I will be a couple of more minutes. No, Carolyn. Carolyn asks if it breaks to the upside, do we still measure the pole and add? No, because this is bearish pattern. You see, this is flagged from the upside. So there is no pattern that it should be below to measure to the upside. Okay, so you should have this price action below this price. Okay, and only then that is called bullish pennant. So bullish pennant is when price action is in uptrend, and then it makes like this, makes a pennant like this. And this is downtrend, and it makes a pennant. So this is bearish pennant. It's not bullish. If you have long here, well, you were lucky because, well, obviously this was breakout point. But the thing is, according to price action analysis, this is bearish pattern. This is no way bullish pattern. No, we don't measure anything if it breakouts. The only thing is you can either take the trade or no. But the thing is we don't measure anything here, okay? Yeah, one more thing, guys. One more thing. Let's talk pound dollar. So this is how you do it. Okay, this is how you do it. If you want to trade 4-hour time frame, you should open your weekly chart, and then on weekly chart you just need to mark most important support and resistance. Because of that, you need to minimize it, and now you can see it more. You can see it really much more easier. Okay, so you just need to mark now moment and history, historical price action. So this is important level. It's very obvious in the history. So next time this level was hit, it should reject. So that is how I do it. I always mark on higher time frames by zooming out and watching those wicks. Okay, obviously 1, 2, 3, 4 points, 5 points here. You see how this level is. It is actually 163.10. So this is a very strong level, and I expect if this is hit, it should be rejection. Now you just need to connect those points. Okay, you see M pattern. This is M pattern. So you look at this. Now tell me, do you see the same? Are you seeing the same as I am? Tell me yes or no. I want answers, guys. Do you think that this level is important? Yes. Yes. Everyone is saying yes. And now, do you see the same? M. Look this breakout point. I show you already today on webinar. This is point 2. Look at the history now versus now moment. This is history, right? 2nd September 2012. Now we are in the present. 7th of June, it doesn't matter. This is present. Now it's August. June, August. Look at the reactions. Look at reaction here. What is this, October? Look at the reaction here. Same spot, rejection. Same spot, rejection. Same spot, false breakout, rejection. Same spot, rejection. Look to the past. Rejection to the upside, but only from these levels. Rejection to the upside, rejection to the upside. Rejection to the upside. M. Look to the history. Breakout. Look this gap here. Gap. Breakout. Guys, that's how you do it. And of course, if you're interested to see and hear more of this, do not hesitate to sign up for Price Action Trading School. We will go step by step. I will lead you to step-by-step trading process and how you should read price action. So we will all have it on price action courses. So I hope that you enjoy the webinar. I hope that you have learned something today. And let's hope that our dollar-yen potential trade or euro-dollar could be successful. So it doesn't matter. We always keep our risk under control, and that is what most important thing is. And pay attention, no matter if you trade by using indicators or you are I don't know, price action trader or maybe harmonic trader, use this knowledge. Use this knowledge, because the price in Forex market always repeats. Thank you. I wish you good evening, and I will be here with you soon. Cheers. Trade safe.